Welcome back in. It's time to talk about your money now. And obviously, you know, if you have a 401k, any kind of retirement account, a portfolio, the stock market has taken a hit. And a lot of that's due with what's going on with the Russian invasion of Ukraine. A lot of uncertainty. Investors don't like that. Stewart Welch from the Welch Group joined us now with some insight on how to protect your money right now and maybe not suffer as many losses. Good to see you this morning, Stewart.
Good morning, Mike.
Look, obviously our hearts for now, our biggest priority and our prayers are with the people of Ukraine. We understand that. But again, we do have people who are, they're either close to retirement age or maybe it's 10 years away, and they're really concerned right now.
Yeah, I think a lot of people are really nervous. What's going on in Ukraine is exacerbated an already jittery market. The market peaked on January the 4th, and since then it's down in really market correction territory, minus 10%. So a lot of people are nervous, particularly with what's going on in Ukraine, where you've got Putin suggesting he's going to put his nuclear arsenal on high alert. And people are asking, should I get out of the stock market? And I think my first response is that it's really impossible to predict what's going to happen. You're hearing everything from this thing's going to be over in a few days and things are going to begin to normalize to we're on the brink of World War III. So with that kind of commentary going on, it's just impossible to predict. So I think what I would do is I would take a look at the other side of my portfolio, and that's the safety net. Mm-hmm. So the safety net is that part that you're invested in that's going to be not subject to the extreme volatility of the stock market. That's going to be money market, CDs, and high quality, relatively short-term bonds or bond funds. And so I divide it into three quick categories. The first one is if you're retired, we're normally recommending that people have at least 3 years worth of living expenses in this safety net. Most of our clients, are more conservative. They're going to have 10 years or more worth of that. And that's plenty of money that you can go to spend on lifestyle to give the market time to recover if we saw a severe pullback into the stock market. And then I think, Mike, the people that are approaching retirement, don't wait until you're actually retired in order to build that safety net. You want to build it as you approach retirement. So if your goal is 10 years worth of safety net and you're 10 years out, you try to get maybe 1 year in this year. I don't think I would do it right now. I'd wait for the market to recover. But when the market recovers, you want to begin to concentrate on that.
Stewart, just to break this down a little farther, for somebody who's maybe 10 years from retiring, should they reallocate some percentages from the stocks over into some of these safety net things like CDs and bonds and whatnot?
Well, if we were talking about, let's say, people that are more than 10 years away, they probably should still have their portfolio dominated by stocks, and this is probably a good opportunity to buy at lower prices. I do think what they want to do is revisit their emergency fund. So normally, and you've heard us talk about it many times, 3 to 6 months of what it costs to pay your bills each month in an emergency reserve. Stop and think about kind of what's going on, and if you're comfortable with that, you might want to increase that to 12 months, 18 months. Some people really conservative, really worried, might do 24 months.
All right, Stewart Welch from the Welch Group. We do appreciate it. Thank you.
Thank you, Mike.
All right, we're going to be back with some good